The dot-com bubble burst.
Fannie Mae sees no end to housing boom.
Wall Street chaos. Lehman Brothers bankrupt. Bank of America buys Merrill.
Flash crash. Machines run amok.
10-year bull market. No end in sight.
Trade war escalates. Market sinks on fears.
Hello, and thank you for joining us for this episode of People and Money, where we discuss money and current events that influence financial markets both here and abroad. This week, we're excited to host Robert Almeida Jr., Global Investment Strategist and Portfolio Manager for MFS Investment Management in Boston. On a high level, our discussion included Rob's early life, how he entered investment management, his roles and responsibilities as Global Investment Strategist, his investment philosophy, his opinions on China's market, Europe's, and our own, his outlook on the cannabis craze and cryptocurrency, and finally, some insights on his personal life. And now, back to our discussion with Rob Almeida Jr. Rob, thank you for joining us today.
Thank you.
Before we discuss your current role with MFS and how your position impacts MFS's view of the world, as we both know, there's a lot of craziness going on out there, so we have a lot to discuss. But before we get to all that, let's learn a little bit more about you. What made you decide to enter the investment management world? Was it your first choice?
No, it wasn't my first choice. So in college, I was a law major with a Japanese minor. My plan at that time, late 80s, early 90s, was to become an attorney, with the hope of representing a Japanese firm that was seeking growth in the U.S. And you recall back then, that was the trend. So my career, which I'm grateful for, of course, in hindsight, took an entirely different path.
Getting into law in Japan, what were your plans for that? Were you planning on representing Japanese companies in the United States, American companies in Japan?
I wasn't sure. I think, in short, it was Japanese companies that were looking to scale their business in the United States. So if you remember, Japanese companies were buying up real estate in Rockefeller Center, Las Vegas, Nevada, and Japan was a huge global growth engine. And of course, as we all know, their massive bubble popped not too long after that.
Yes, they crashed and burned. I know out here on the West Coast that they bought Pebble Beach for about $900 million and sold it back for about $300 or $400 million.
That's right.
Take us through the early days of Rob Almeida. Where were you born?
Taunton, Massachusetts, about 45 miles south of Boston.
Okay. What about your upbringing? What were your parents doing?
My father actually had three jobs, but his main job was he was a warehouse worker for a local supermarket chain here. My mother raising four kids, and she ran a small family tobacco/party store business that we had.
Was there anything in your younger days that steered you towards global investing and MFS in particular? Were you investing your own money?
No, I wasn't. Although, well, yeah, I do remember my father had given me shares of a small local company here back, God, that would have been in the early 80s. That was my first interest. But when the crash of 87 happened, I had a business teacher in high school that was talking about it. And that, I guess, fascinated me just more conceptually of financial markets were a forum or are a forum where capital seekers and capital givers come to meet. And I just thought that was interesting.
That is an interesting take on it. What was your first job not on Wall Street?
So let's see. First job was worked for a company coming out of college, and they were importing and wholesaling goods in the United States and expanding in the West Indies. And they did that door-to-door sales. So I was offered an opportunity to relocate first to Barbados and then a year later to Jamaica. So I did that for a couple of years and then moved back to Boston, 1995. And that's when I began my financial services career.
And that's when you began your financial services career at MFS?
No, it was another asset manager across town here in Boston. And back then, there was they called it Big Bang. There was a major regulatory change in Japan that finally allowed foreign investment advisors to start managing pension money in that country. And at the time, it was a huge vertical, a huge industry. So you had two tailwinds happening. The internet boom was taking off. The equity market was accelerating. The global economy was reaccelerating. And now you had asset managers all fighting to gain market share inside Japan. So my Japanese language skills, which I had learned in college, allowed me to essentially backdoor into a firm.
Your obviously potent Japanese skills got you to where you wanted to be.
Correct. So most of the portfolios or strategies that we were managing were fixed income. So that was my exposure to fixed income investing, and it was more of a on-the-job training and learn-as-you-go type thing. So that was, literally 1995, 1996. And so I left that organization in 99. That's when I came to MFS. And I stayed within fixed income for about another 8 or 9 years or so.
So you started out as a fixed income manager at MFS, and then you went into the global investment realm on the equity side as well, right?
That's correct. Yeah. So in 2009, it was about a year after the financial crisis. They had asked me to move over specifically to work on U.S. large and mid-cap growth strategy. And so I did that from 2009 till, formally till the end of 2018.
Well, coming out of the recession in 2008, 2009, it must have been a great opportunity to be investing mid-cap and large-cap growth stocks.
It was a whole different, on one hand, it was a whole different realm. But on the flip side, at the end of the day, investing is pretty simple, right? It's cash flows. So whether you're buying public shares of a technology company or a REIT or an apartment complex or a fixed income instrument, conceptually, it's all the same. It's what are the cash flows that the enterprise throws off versus what the market thinks it's throwing off? What's the durability of that, and how much is the market discounting that? So conceptually, it's the same thing. So once I kind of came to grips with that, I just applied the same concept to equity investing.
Interesting. Let's talk about your current role at MFS. What exactly does a global investment strategist do?
So I have two functions. The first is I'm a lead manager on a multi-asset income portfolio, and then on a long-short strategy. So that's one function. The second, more descriptive of the global investment strategist title. So in that capacity, I think about it as my job is to represent where our active investors, analysts, portfolio managers, et cetera, around the globe are identifying enterprises with cash flow durability, but more importantly, also identifying those without. So those assets whose cash flows are unsustainable. And so durability, I think, is kind of a nebulous or vague term. It's one that we all use quite frequently in the asset management industry. To me, specifically, it just means a company that does something unique that affords them the ability to, if not raise price, the ability to hold price. So if you're doing something unique or different that's hard to copy, then there's probably a high probability that the cash flow across a business cycle is durable and the asset's going to hold its value.
So can you give me a couple of examples of companies who meet your criteria?
Yeah, I think in simple terms, just take washing machines. So, you can name 5, 6, 7 different washing machine brands. And I think the dispersion between washing machine A, B, C, D, and E is probably fairly low. Whereas laundry detergent, however, possesses a bit more brand equity, right? You can probably only name one or two. And so the cost of the detergent is pretty low. The brand equity and thus the demand is pretty high, so there's more of a recurring nature to it. And so it's a lot easier for the soap maker to hold price or even to raise price when they need to versus, say, the dishwasher maker or the washing machine maker, because what they sell is more of a commodity or sorts. Or maybe a more simple example is coffee. So coffee is obviously a commodity, but when you think of coffee chains that have high brand equity, Starbucks or Dunkin's, we certainly don't think of them as commodities, and certainly the market doesn't think of them as commodities given their equity returns. And so they take the commodity and they make it into something else. And maybe it's the experience in the store, maybe it's the foam on the latte, I don't know. But clearly they're doing something that's different, hard to copy, that people are willing to pay more for. And so if you're willing to pay more for something, to me that defines durability. That's the definition of something that's above average. And that's generally what we're looking for, above average businesses. I call it the second derivative. So instead of trying to ascertain who's going to be the future dominant provider of electric vehicles or autonomous vehicles, I have no idea when they're going to manifest and penetrate society, but it's coming. Instead of trying to ascertain that, I think it's a much better investment to own the suppliers. So the suppliers are more likely someone that's specialized. It's a cog, a part, an ingredient that the manufacturer cannot do without, and more importantly, the supplier is able to sell that across all the different automotive industries. And so during a cycle upturn, Ford or General Motors or Tesla are going to be better stocks because as more people are buying cars, they're going to be better stocks. But peak to trough, trough to peak, cycle to cycle, since I can't anticipate what the economy is going to do, since I can't anticipate how many people are going to be buying new cars, I'd much rather own the one with better cross-cycle intellectual property and cash flow durability. And in general, it's the suppliers.
Now, you'd mentioned in a previous conversation a price floor. Can you expand on that?
Sure. So if you do something that's hard to duplicate, if you do something that's unique or differentiated, there's generally a price floor with what you do. If you think back to investments that have gone awry, so why didn't the thesis manifest itself? Why did this go from being what we thought was a good investment to becoming a bad investment? What went wrong? And not all the time, but often we mismodeled or misascertained the idiosyncrasy of what the company does. In other words, someone else was able to copy it. And so a poor elixir for an investment outcome is when there's a price war. So when there's a price war, generally what you have is a company with a fixed cost structure to the business. They're having to cut price to keep up with a more fragmented market. And what happens is margins fall, profits fall, and stock prices follow profits. It's as simple as that. So if a company has something that's hard to copy and it affords them a price floor, or better, it actually affords them the means to raise price, you're going to it's a much higher probability, a much better outcome of margin durability, even margin growth, and that's going to lead to above average stock returns.
Let's talk a little bit about pricing and the ability for companies to raise prices. It seems that we're running at around 2% inflation, maybe even a little less than that, and it's just very difficult for any company to raise prices. Do you see that continuing? Do you see there's some opportunities out there for certain American companies or global companies that you're investing in to raise prices? And if so, by whom?
I think you just nailed the heart of the problem, and basically the explanatory reason why inflation has been so non-existent this entire business cycle, which is now 10 years. And so if you think about products that we all use today and take for granted, the telephone, automobiles, television, radios, et cetera. If you go back in time and look at when those things first came out and how long it took until 50 million households owned a TV or owned a refrigerator or owned a dishwasher or had a radio, had electricity, these took 30, 40, 50 years because the products were expensive. So they had pricing power. Those products weren't commodities. Mm-hmm. Today, however, what's happening is internet platforms are duplicating so many functions in society today. And so these new products that are coming out, they're for free or close to it. So if we look at some of the popular video games that have come out over the last year and a half, like Fortnite, for example, it took 3 or 4 months until they had 50 million users because it was for free. And so as technology is becoming cheaper and at the same time duplicating the value proposition that others have historically provided, what it's leading to across a multitude of sectors is just, in simple terms, a price war. And it's happened in our industry, in financial services. So the advent and the growth of passive has done a tremendous service to the end consumer within financial services because it's created a price war. There's just more options. And so to answer your question, looking out, I think when I think about the next 5 years, 10 years versus the last 5 versus the last 10, there's going to be fewer companies with something different, unique, that affords price. But those that have it, they're going to be worth materially more because they have scarcity value. Whereas those that don't have it, I think, see margin degradation and stock price decline. Now, you're seeing this in the market already. So take a look at retailing, for example. Retailing is an industry that is grossly fragmented. We have way too many stores, and we've had more store closings in the last 3 or 4 years than we've ever had in the history of the United States. And that's in an environment where unemployment's at a 40, 50-year low. So what's happening? You have other options, e-commerce. It creates infinite shelf space. It creates transparency. It creates more informed consumers. So all of that leads to price erosion. And so when I think about, from an investing standpoint, how can we add value to clients, to our investors, it's avoiding those companies that refer to as terminally value challenged. What they do is no longer of value to society, and the company will go away and die. And so I think we're going to see an increasing element of those, and avoidance of those institutions, both their stocks and their bonds, I think is what's going to differentiate from good managers and bad.
I'd never actually heard the term infinite shelf space, but the internet and Amazon certainly make me aware of that. Let's take a swing at some of the global markets that you invest in. The number one story in the global markets today is China, or as our president calls it, China. What's your opinion on the Chinese economy? So
I think everyone's well aware of how quickly China has grown and become an economic superpower. The economy's quintupled over the last 20 years. But one of the biggest mistakes that I think investors make is confusing correlation and causality. In other words, there isn't a tremendous relationship between GDP growth and equity market returns. And so if you juxtapose what U.S. stock prices have done relative to Chinese stock prices, you'll see a stark difference, particularly when you align two very different economic growth trajectories over the last 10 to 20 years. So I think China is incredibly important obviously from a political standpoint, from a conflict standpoint, but from a financial market standpoint, ultimately, what does a company do? How do they do it? Do they have intellectual property that affords them the ability to keep doing that and keep holding price? And when you look at the U.S. equity market for the last 10 years, it's been the best performing market, but that's not what's important. It's been the best performing market for the last 100 years because of our legal structure. Our legal structure affords creative destruction. If something isn't of value to society, it dies. And so when I think about other markets that don't have that legal infrastructure, that creative destruction, that's what makes the U.S. Equity market, that's what affords it its superior risk-adjusted returns.
Well, that's two terms that I hadn't heard before this conversation, creative destruction. So that's, I don't know if that's good, bad, or indifferent, but we shall see. What about China's expansion? They have what they call the Belt and Road Initiative. They seem to be buying up prime real estate in every port and major metropolitan area in the world. Is that sustainable? And as Americans, should we be worried about it?
Yeah, so I think there's two different questions in there as you ask. So as an American, so not as an investor for a moment, but as an American, when we look at the political stage and the tension, of course, it would be disingenuous to suggest no. But from a financial market standpoint, what I think gets left out in media coverage surrounding China's growth is the massive amount of debt that they've accumulated. So their growth has not come for free. So they've decelerated from a 12% GDP growth rate to something where it is today of 5 or 6%, and that's if you can believe those numbers. It's probably materially lower than that. They've got a tremendous debt buildup, not just in the public sector, but in the private sector, and now they've found themselves engaged in a pretty significant tariff war. So it's not a one-side advantageous scenario. They've got pretty significant problems that I think will prohibit some of the things that they perhaps would like to do, and I think should cap some of those fears that people have.
Do you think it's a replay of what we discussed earlier about Japan's expansion in the late 80s and 1990s?
Yeah, it very well could be. The difference, though, is you're looking at Japan, a country that's a tenth of the size, not a lot of land mass, has to import a lot of things, where China's very different, has a lot more wealth, has much cheaper labor, and has more levers at their disposal so they can kick the can down the road. Basically, is what I'm trying to say. So I think it's probably going to end a bit differently, where Japan's ended abruptly in pain in 25 years of zombie banks, zombie companies, and inefficient markets and deflation. I think China can kick this problem down the road a lot longer because the structure is very different.
You mentioned that we're in a trade war. It's a non-shooting war, but it's still having tremendous impact on the world's economy and commerce. How do you think this trade war will end?
So I don't know how it'll end politically, obviously. That seems to change day by day. I do think, however, though, there's two narratives that market practitioners and strategists are talking about. One is that trade wars lead to pricing power and inflation. And the other narrative, which is the one I subscribe to, which is companies do not possess pricing power. They have to eat the tariffs, and it accelerates profit deterioration. So when I think about the cost of supply chains and input costs, for companies that are subjected to tariffs, are they going to be able to pass that along to the consumer in an age where consumers now have infinite choice? That isn't, we're not seeing that in the data. So I don't subscribe to the inflationary environment from that. I think what we're more likely to see, assuming full tariff war, is that it's not the consumer that gets hurt, it's the companies involved themselves. And I think ultimately water finds its own level, and the water level has been distorted the last 6, 7, 8 years because of the interest rate policy and because of passive indiscriminately just deflating the cost of capital. And so as I think water starts to find its level and you start seeing profit erosion, whether it gets sped up from tariffs or not, that starts to manifest itself into asset prices. And you're kind of seeing that this year. When you look at the performance of the equity market, aside from the double-digit return, just the difference between stocks that are outperforming and stocks that are underperforming, the ones that are underperforming are more levered to what should be higher input costs from a trade war.
Thanks, Rob. We'll be right back after a word from our sponsor, the Olympus Insurance Agency.
This episode of People and Money is brought to you by the Olympus Agency Insurance Solutions. The greatest risks we face are those we fail to foresee. Life risks can have significant impact on your client's financial well-being. The Olympus Agency can help you cover those risks that may present gaps in the retirement plan. The Olympus Agency can help with individual clients' insurance needs, group insurance, and business insurance. The Olympus Agency can help with longevity planning. And the Olympus Agency can help you differentiate yourself in a crowded and competitive market. We offer best insurance and annuity solutions, a personal touch and consultative approach, access to advanced insurance experts, underwriting advocacy, training, and competitive payouts. Curious? Come check us out at www.theyolympusagency.com.
All right, let's talk about investing right here in the old USA. The markets were on fire in the first quarter, but we've had some pretty dramatic dislocations over the last couple of weeks. What does our economy look like over the short term and maybe even over the longer term?
Sure. So as we talked about earlier, the way I categorize this business cycle, so the economic cycle has been above average in duration, right? I mean, how many times do you hear or read this is the 9th, 10th year of a business of a economic cycle, but it's been below average in growth. And the reason it's been below average in growth is, again, because we're shifting to a renter's economy from an owner's economy. And so economic recessions are built because something in the economy becomes overbuilt and overbought with leverage. And so when we look at the economy today, given the health of the labor market, the labor actually has pricing power. So wages are going higher, unemployment's at a 50-year low. So I think the economy's fine, right? 2%, 2.5%, whatever it is. I don't see a recession in that regard. But that's not what's important to, I think, your constituents listening to this podcast. What's important is what's going to happen to my portfolio. And those are two very different things. And so looking out over the next 5 or 10 years, I just think we shift from this cycle that's been above average in margin, above average in profits, right, largely because of cost cutting and stock buyback, that shifts to, okay, who has revenue growth and who doesn't? Those that have it, it's because they have something unique or different, and those assets will do just fine. Those that don't have it won't. And I think that's what we can expect. At least that's what we're expecting, looking out over the next 3, 4, 5 years. And so, the last 10 years, there wasn't a heck of a need to have discretion with your portfolio. You could just indiscriminately own the market and you would be just fine. I think returns are going to be below average, and if that isn't good enough, then I think you need to be more thoughtful, more selective, and I think you can do markedly better just by avoiding some of those terminally valued names that we talked about earlier.
Got it. Coming out of the 2008-2009 recession, it was large technology stocks that have led the way and have led the way for the last decade. You think that song will keep playing?
So when I think about technology stocks, I get that question often in the context of the parallel to the TMT bubble in the late 90s. And the late 90s, that was a hardware bubble. So those were technology companies selling hardware, and it was overbuilt and overbought. This cycle here, these are internet platforms with massive scale that are attacking other industries that we never even thought of, right? So Google attacking media via YouTube, for example. That's very different than Cisco selling routers in 1996. And so it doesn't mean that they're not overvalued or overbought, but I do think today these internet platforms have a value proposition that's different, that's unique. They're affording companies a much cheaper and more efficacious way to advertise their goods and services. It's affording companies the ability to sell products direct to the consumer. So companies that sell web-based software to Nike or Adidas that allows them to sell those goods directly to you and I versus going to the mall to buy it. So that's all margin accretive. And so I think a big difference with technology stocks today versus then, but the devil's always in the details. And I think you've got many companies with excessively high valuations that do something that's not really different than what the current incumbent provides. And conversely, you have other technology companies that have an analog moat, something that's really hard to duplicate. And I think it has viability and staying power. We were talking about pricing power earlier. Netflix is actually one of the few companies within media that's raising price. Why are they raising price? Because they're providing a utility that people want. So I think there's some staying power to it.
Do you see any surprises on the horizon, something that could change your mind or cause the economy to crash?
Well, you never see the bullet that hits you, right? So if I name it, it means it won't happen by definition. But I guess to the spirit of your question, things that I worry about my biggest fear right now is corporate debt. So unsustainable margin structures. So companies that possess something that people don't want and they're over levered, that's unsustainable. So those companies will go away and die. And I don't know what the ramifications are of that, how much of that is owned in passive and ETFs, et cetera. So that's first and foremost on the fundamental side. On the other side of the equation, things out of left field that I worry about that people aren't really talking about, securities lending. So securities lending is up 30, 40, 50% the last 7, 8 years. And most of those stocks out on loan and bonds out on loan, they're all collateralized. So it's fine on paper. But what happens if we have a long-term capital management like event, like we did in the late 90s, where hedge fund ABC can't deliver Apple stock that's out on loan back to the ETF provider that's being redeemed because of whatever. So So these things are all untested. So it's just, I don't have any proof points or substantiating evidence that this should be a fear, but there's a number of institutional investors that are getting a risk premium from securities lending that they think is for free. And as you and I both know, there's no such thing as a free risk premium.
Well, it's interesting because I know that there's a lot of ETFs and mutual funds that are invested in the S&P 500, and they're 0 basis points or 1 basis point for their cost. So they're making their money on securities lending. And
that's right.
Thus far, that hasn't been a problem. But what you're saying is there could be a problem down the road that could cause a massive sell-off of the S&P 500.
Yeah, it's just an area that we don't have a lot of experience in. So again, I think passive and ETFs, as I mentioned earlier, I think they tremendous utility. In short, they've democratized investing. They've created a price war. Net, the consumer wins. But there's, 50,000, according to the World Bank, 50,000 stocks investable in the world, give or take, something like that. Mm-hmm. There's close to 4 million benchmarks and ETFs. So you've had a parabolic explosion in a number of these vehicles. And as you stated correctly earlier, a lot of them are making their money on sec lending. And so, hopefully this won't be a problem, but it's just something in the back of my mind that I think about.
All right. Well, now that you've scared me, let's talk about a couple of industries that are often on the front page of the newspaper rather than the business page. I saw a YouTube you did when you were talking about cannabis. People are buying marijuana everywhere and for everything. CVS is selling CBD cream for whatever ails you. And I've got a good friend, a lawyer, who sold everything in San Diego and moved to Colorado to create a vertically integrated seed-to-store marijuana company. Is this just reefer madness, or is this an investment?
So I think about it in two ways. One, so obviously accessibility from a legal standpoint to cannabis has grown immensely. So it started with Uruguay, 2014, I think, followed by Canada last year. And now here in the States, we have 10 states plus District of Columbia, I believe, where it's approved not just medically, but recreationally. So when you add it all up, it's about 2/3 of the U.S. population that has access to marijuana legally, at least from medical means. And so the demand has grown immensely, and cannabis stocks have followed suit. So back to the question, is this a viable investment opportunity? And as I tried to allude to in the video, when something is growing at that scale, when units are scaling that fast, from an investment standpoint, at least what I care about is there someone within that product provider that does something unique? So who's the Starbucks or Dunkin' of cannabis? Who's the Apple of cannabis? If there isn't one, then it's like blockchain technology or 3D printing or dishwashers. It's just, product A, product B, product C. And then pricing, a lot like in passive, it just falls to the bottom. So then it gets really hard to assess cross-cycle cash flows if you can't identify someone with something unique or different. The other way I think about it is, or this is the way we're talking about it right now, is assuming that marijuana continues to grow and demand continues to escalate. What risk does that bring to companies that we're exposed to? So we call it our buzz budget. So we all have buzz budget, right? So how much do you spend on beer and alcohol in a month? Or how much do you spend on spirits in a month or a year or whatever the time frame may be, right? We all have these at least implicit budgets of how much you're going to spend. And so if incrementally people are getting more of their buzz, so to speak, from something else that isn't beer or isn't white wine or isn't brown spirits, how does that cannibalize and how does that change the cash flow calculus? So that's what we're watching for right now.
So by me going into my local dispensary and buying a bunch of grass, it could actually reduce the amount of trips that I make to Bevmo for my wine.
Exactly. Here's what's interesting, and it's too early to pull anything from this, but it is just kind of fun or interesting data. So Uruguay, as I mentioned, was the first. But if you look at early states like Washington and Colorado, where we've got a longer sample size, so take Uruguay, take Washington, take Colorado, beer volumes globally have been in a secular decline, particularly as millennials are shifting towards more less carb-heavy drinks. In those places where marijuana is recreationally legal, beer volumes have actually ticked up. So we'll see if that trend sticks, but it seems like people are staying home, consuming the plant, and guzzling beer, I guess.
Well, it's 2 of the 4 food groups. Okay, if that wasn't scary enough, I have another friend that is invested in roughly a dozen different cryptocurrencies. He considers Bitcoin a core investment. In 2017 and 2018, people made and lost fortunes in crypto. You're a bit of a crypto expert. What are your thoughts on the future of Bitcoin and the whole blockchain disruption of the world's currency market?
So I think blockchain technology is a revolutionary technology that tends to get lumped into the Bitcoin conversation. So blockchain is the plumbing that makes cryptocurrencies work. So let's maybe take blockchain out for a moment and just talk about cryptocurrencies as an asset. So 2 points to it. One, it's infinitely divisible, which I find ironic because the whole value proposition of crypto was to move away from fiat currencies and governments deflating and devaluing their currency. So when something is infinitely divisible back to pricing power, it doesn't have any. So that's not a good start when you're kind of going down your investment checklist. 2, they don't produce a cash flow. So given points 1 and 2, how do you value it? So the supply is infinite, and there isn't a cash flow that you can discount. So is Bitcoin worth 5,000, 10,000, or 100,000? I just don't know how you assess it. The other element back to blockchain is latency. So the value proposition of blockchain is it's immutable. It's permanent. It cannot be erased or changed. It's forever. So there's a value to that when you're keeping ledgers. There's a permanence and definition to it. The give up to that is that it's slow. So I think the reason blockchain and crypto hasn't penetrated society at the consumer level is no one wants to be that person standing in line at Macy's or CVS or Starbucks holding it up because you're taking 8 minutes to process your Bitcoin purchase.
Well, especially if you're standing in line at CVS to buy marijuana and taking 8 minutes to pay Bitcoin. So we can combine the 2 industries. All right, Rob, now we'd like to play what we call the speed round. A few quick questions about you and your past. Are you ready?
Let's go.
What's an event that surprised everyone in the market, including you?
Let's see. I think it was the reversal in tone of the Fed earlier this year and the massive re-rating of risky assets. So I was surprised at, I guess, one, how tone deaf they seemed to be in Q4, and then how quickly they reversed in Q1, and then the market's response in both occasions. And I think just given the market's reaction, I think we can argue it took everyone by surprise.
Well, it is amazing what a few tweets from 1600 Pennsylvania Avenue will do. Rob, on a personal note, what are some of your favorite books?
So I generally read fiction, but when I'm not reading fiction, for business books, favorite one of all time is Manias, Panics, and Crashes by Charles Kindleberger.
Do you have any hobbies when you're not moving hundreds of billions of dollars around on your global chessboard?
Sure. Well, I have two kids, 15 and 12, which are not hobbies, of course, but that cannibalizes, that's the wrong word, that occupies a lot of my non-professional time. So when I can, we try to go fishing. So I live just north of Boston off of Cape Ann, so it's the cold Cape, or the Cape you never heard of, and just try to catch sea bass off the shore.
And how successful are you at catching sea bass?
I'm terrible. If it was a profession, I would have been fired.
All righty. Last question, and we ask everyone this. If I were a first-time investor with $10,000, where would you tell me to invest it? And remember, I want to make some serious cash.
Okay, so if I was an investor with $10,000 looking out, and I think investing is hard, but really simple. The simplicity of investing is it's just cash flows, right? Cash flows drive asset prices. The hard part is ignoring everything else around it, what the Fed did, White House tweets, things like that. So for an investor today with $10,000, 8, 9, 10 years into where we are in this cycle, I think it's more critical than at any point over the last 10 years to own an asset or to own assets with cash flow durability. So for those asset owners that are, listen to your podcast with regularity, it's more important than ever before, I think, to be emphasizing the risk in your portfolio versus just the return. So what does a company do, or what does this portfolio do, and does it have durability? And if it does, it'll be just fine. Abraham Lincoln once asked, if you call a dog's tail a leg, how many legs does it have? And the answer is 4. So I think in our industry, we overcomplicate the world today with factors and style, growth, value, U.S., non-U.S., and domicile. If a company has cash flows, that $10,000 will grow, regardless of what's going on around us. If it doesn't have cash flow, you're going to have a lot less than what you started with.
Oh, and I've done that before. Rob, thank you for joining us on People and Money. We really appreciate your time and your insight. You can follow Rob at www.mfs.com/insights/the lack of an impulse. Thanks again, Rob.
Thank you.
For more People and Money, be sure to subscribe on YouTube at people.and.money. Follow us on LinkedIn, Instagram, Facebook, and Twitter. We want to hear from you. Tell us who you'd like to hear on People and Money by leaving a comment. This is your host, Jeff Kayajanian, signing off.